The Greek financial crisis, how the Eurozone's currency paved the way. Hello, and welcome to today's video, where we'll be discussing one of the most significant economic crises in recent history, the Greek financial crisis of 2009. Specifically, we'll be exploring the role that the euro played in causing this crisis, and how the situation in Greece was emblematic of larger structural issues within the European Union. So sit back, relax, and let's delve into this important topic. In 2009, Greece faced a severe economic crisis that had devastating effects on the country's financial stability. Many experts argue that the introduction of the euro played a significant role in causing this crisis. Before the euro's introduction, Greece had its own currency, the drachma. The government could control the money supply and set interest rates to suit the country's economic needs. However, when Greece adopted the euro in 2001, it lost control over its monetary policy. The European Central Bank, or ECB, became responsible for setting interest rates and controlling the money supply. This worked well for countries like Germany, which had a strong economy and stable financial system. However, Greece's economy was much weaker and not as stable, which meant that it could not keep up with the demands of the Eurozone. The Greek government had been spending more money than it could afford for years. It had borrowed heavily to fund its lavish public services, such as healthcare, education, and social welfare. When the global financial crisis hit in 2008, Greece's economy suffered a severe blow, which exposed the country's underlying problems. As the Greek economy began to collapse, the country found itself unable to pay back its loans. The Greek government had to turn to the International Monetary Fund and the European Union for help, and in 2010, a bailout package was agreed upon. This came with strict conditions, including austerity measures that were deeply unpopular with the Greek people. The euro's introduction had created a situation where Greece had access to cheap credit, which it used to fund its excessive spending. When the global financial crisis hit, Greece found itself unable to pay back its debts, which ultimately led to the crisis. The inability to devalue its currency or set its interest rates meant that Greece had no control over its monetary policy, leaving it at the mercy of the Eurozone's larger and stronger economies. The Greek crisis of 2009 was a wake-up call for policymakers in the Eurozone that a one-size-fits-all monetary policy cannot work for countries with vastly different economic conditions. The introduction of the euro had many benefits, including reduced transaction costs and greater economic integration. However, it also had drawbacks, as it restricted countries' ability to control their monetary policy. Greece's entry into the Eurozone in 2001 was seen as a sign of its economic modernization and stability. However, the country's public finances were in a precarious state, with high levels of debt and a large budget deficit. The lack of control over monetary policy meant that Greece could not devalue its currency to boost exports or lower interest rates to stimulate economic growth. Instead, it relied on cheap credit to fund its spending, leading to a massive accumulation of debt. When the global financial crisis hit in 2008, Greece's economy was hit hard, and its debt crisis became a full-blown financial crisis. The country's public debt-to-GDP ratio reached 120%, and the government found it increasingly difficult to borrow money from international markets. The crisis resulted in a sharp decline in the country's economic growth, high unemployment rates, and widespread social unrest. The Greek crisis highlighted the challenges of a monetary policy that did not take into account the different economic conditions of each country. The Eurozone countries had vastly different economies, with some countries having strong export sectors, while others relied heavily on tourism or services. The one-size-fits-all monetary policy meant that the ECB had to set interest rates that suited the needs of the entire region, rather than individual countries. This led to low interest rates in some countries, which fueled a boom in housing and consumer spending, and high interest rates in others, which made borrowing expensive and stifled economic growth. In response to the crisis, the ECB and the European Union introduced a series of measures to stabilize the Eurozone. These included the creation of the European Stability Mechanism, which provided financial assistance to countries in crisis, and the implementation of fiscal rules, which required countries to maintain a balanced budget. The lesson learned from the Greek crisis is that policymakers must take into account the different economic conditions of each country when designing monetary policies. A one-size-fits-all monetary policy may work well for countries with similar economic conditions, but it can be detrimental to countries with vastly different economies. As a result, policymakers must be flexible in their approach, allowing individual countries to tailor their monetary policies to suit their specific needs. And that concludes our discussion on how the euro caused the Greek crisis in 2009. It's clear that the European Union's monetary policies and the flaws within the Eurozone itself were major contributing factors to Greece's economic downfall. This crisis serves as a stark reminder of the importance of proper financial regulation and oversight, as well as the need for international cooperation and support during times of economic turmoil. Thank you for watching, and we hope you've gained valuable insights into this critical event in history.